Have you ever felt that chill, that strange feeling that something big is about to happen, even though no one is talking about it yet? That's right. The most attentive investors are already feeling it. The silent alert was triggered. The yield curve, the indicator that predicted all the major crises of the last century, just moved again. Yes, the same curve that flashed in 2008 before the market crash. Who gave the signal in 2001 before the bubble burst? And that shouted in 1929, just before the world plunged into the Great Depression. She made the same move now, and almost no one is talking about it. But why does this matter to you, especially if you live off dividends? Because if history repeats itself, companies that currently pay good dividends may be the first to feel the blow. Profits fall, payouts shrink, and what seemed like guaranteed income goes up in smoke. But, like every crisis, it is also in these moments that the greatest opportunities arise. The question is, will you be prepared or will you be caught off guard? Now here comes what has a lot of people confused. If this sign is so powerful, if it always hits the mark, why aren't we in crisis yet? The United States economy is growing, unemployment remains low, and the stock exchange, it's at historical highs. None of this sounds like a recession scenario, right? It's like the sky is blue. But someone said, the storm is coming. You look at the sky and think, there isn't a single cloud. But here's the point that few understand. The market and the real economy do not always speak at the same time. It's like an echo. The signal comes first. The impact comes later. And if you live off dividends, this is even more serious. Because when the economy starts to weaken, companies cut costs. And do you know what's one of the first things they cut? Dividends. So don't be fooled by the silence before the thunder. The question is not if it will happen. The question is, will you be positioned the right way when it happens? Want to stay one step ahead of the next recession and protect your dividend income? Sign up now and stay up to date with the best analysis. Look, I understand what you might be thinking right now. Maybe this yield curve thing doesn't work anymore. The economy has changed, it's different now. There's AI, there's big tech, there's the Fed throwing billions into the market. But let's keep our feet on the ground. We are talking about the only indicator that has predicted every major recession since before your grandmother was born. And he is based on opinion. It is based on real money. How big investors are positioning billions in government bonds. Do you really think these people move billions by chance? This curve doesn't look at newspaper headlines. It reacts to real fear, to the credit crunch, to the behavior of banks. And when she unwinds, as she is doing now, it is as if to say, the Fed has already started preparing for what's coming. What about you? And here's the point that no one talks about. The dividend market is usually one of the first to show signs of weakness in this scenario. Because when interest rates fall, investors rush to safe assets, such as bonds. And this puts pressure on stock prices, especially for companies that pay high dividends. I.e., if you're hoping to live off dividends, now is the time to watch like a hawk. This is no time to panic. It's time for strategy. Now, if you are wondering, okay, but what exactly is this yield curve that everyone talks about? Let me explain it to you in a simple way. Think of a graph. On one side, time. On the other, the interest the government pays when someone lends it money by buying bonds. It has a 2-year, 10-year, 30-year title. Normally, the more money you lend to the government, the higher the interest you receive. Makes sense, right? More risk, more reward. But sometimes, something strange happens. Short-term interest gets bigger than the long-term. It's as if someone said, man, I want my money back soon, and I don't have much faith in the future. This is called yield curve inversion, and whenever it happens, there is a crisis. Now, when the curve starts to rise again, the so-called steepening, means that the Fed is cutting interest rates, trying to save the economy before things get ugly. And here comes the trick. This moment, when the curve uninverts, is when the game starts to turn. This is the point where banks start to cut off credit. Companies have more difficulty growing, and the profit starts to leak out over the edges. And guess what? When profits drop, dividends are the first to be cut. Therefore, understanding this curve is more important to you than following the news. She doesn't scream, she whispers. But whoever listens anticipates. If dividends are your source of income, don't take unnecessary risks. Click subscribe and follow market signals with us. Remember when gas was expensive, credit card interest rates were sky high, and the Fed, the US central bank, kept raising interest rates like it was trying to put out a fire with a fire hose? Well, that was what they called restrictive policy. The Fed did this on purpose. It left short-term interest rates high to try to cool the economy, and it worked, at least on the outside. But there is a side effect that many people forget. When the Fed tightens too much, banks lock up, they stop lending, credit dries up, and small businesses start to bleed. And do you know what these companies do first? They cut dividends. This happens before fire, before announcing losses, before going bankrupt. Cutting dividends is the first sign that financial health is deteriorating. Now the Fed has begun to change direction. It's giving the first signs that it's going to start to cut interest rates. But it's not because the economy is healthy. It's because they felt the impact. They know what's coming, and they want to ease up before the blow hits. So if you depend on dividends, or do you get ahead of the game and reposition yourself now, or you risk holding on to stocks that will stop dripping money into your account month after month? The movement has already begun, and the next decision is yours. 6. We are at the exact point where crises usually arise. This is where it all starts to get more serious. When you look at the data from the last major crises, 1989, 2001, 2007, 2020, there is one thing in common. They started exactly when the yield curve was at the same point where it is now. It's as if the economy is walking through a minefield, and we had just stepped on one of those red dots. It's not maybe anymore. It's not maybe next year. It is the exact moment where, historically, the market begins to turn, and that matters a lot for those who live off dividends, because you may be positioned today in stocks that seem safe, but that historically are the first to cut dividends when the cycle turns. Examples: banks, energy companies, even large REITs. They all got hit hard when the curve reached this exact point in the past. In other words, if you think the risk is small just because prices are still high, be careful. The market often looks safer, minutes before the abyss. Now is the time to look at the portfolio with cold blood. Leave emotions aside and ask, if the dividends disappear tomorrow, am I ready? Don't let the next crisis catch you by surprise. Sign up to receive alerts and strategies to protect your investments. If you went back in time to July 2007, do you know what you would see? The yield curve is at the same level it is at today. The bull market, optimism dominating the headlines, and dividend investors feel at ease, like nothing can go wrong. But a few months later, the collapse came. Dividends were cut en masse. Stocks that seemed like eternal payers turned into a dry well. Now, listen to this. We are at the same point on the curve. The data is almost identical. And if the story rhymes, as it often does, the real impact can start in the next 3 months. 3 months. It is the time that separates a prepared investor from a regretful investor. The yield curve is rising, and this, historically, anticipates the fall in dividends. And those who wait too long to act, you often discover too late that profits and payouts are the first to evaporate. So think with me. If you were in July 2007 with everything you know today, would you have done anything differently? If the answer is yes, then you already know what you have to do now. Imagine the following scene. You're driving down a highway at night. Suddenly, Your dashboard starts flashing, the engine warning light comes on, your GPS starts to freeze. Everything indicates that something is about to go wrong. But you keep driving. Mile after mile, nothing happens. And then you think, maybe it's just a bug in the system. That's exactly how many investors feel right now. The yield curve, that silent but incredibly accurate dashboard, already sent the alert. It rose more than 1 percentage point after a reversal, and this, historically, always marked the beginning of a recession. In the Great Depression, in 2001, in 2007, in 2020, always. But now, the economy is still standing. Unemployment did not skyrocket. The stock market, it's breaking records. So the question that echoes in the market is simple. What if this time the alert is wrong? It almost seems comforting to think like that, doesn't it? But here's the cold, hard truth. If the curve keeps rising and the recession doesn't come, does not mean we are saved. It means we are entering a territory where no one knows what to do. And this is worse than a traditional crisis. Because in a recession, you know what to expect. Profits fall, stocks correct, dividends shrink. But when the market stops reacting to alerts, when logic stops working, you are no longer dealing with risk. You are dealing with total uncertainty. And uncertainty is the poison of passive income. Companies stop distributing dividends, not only because of lack of money, but they don't know if they'll need it to survive. Even solid companies with cash in hand can suspend dividends just in case. Do you realize the danger? The risk is not just losing market value. It is to see your income dry up overnight, even with your shares intact in your portfolio. Now stop and think. If your financial independence plan depends on constant dividends, are you really prepared for a scenario where the biggest indicator in history fails and the market goes into silent panic mode? This is the kind of question that separates those who survive the cycle from who becomes a statistic on the graph of the next crisis. Let's imagine a game of dominoes. The first pieces have already fallen. The yield curve inverted, then sharply uninverted. The Fed has already changed its tune. Credit started to get harder. Some companies have started to hit the brakes. But there is one piece that is still standing, the job market. It's like everyone is saying, as long as people still have jobs, everything is fine. But that's the final trap. Do you know why? Why is the job market the last to fall? And when it falls, falls all at once. In 2007, the number of unemployment insurance claims in the US was low, until suddenly it started shooting. And right after that, the avalanche came. Companies cutting costs, freezing hiring, suspension of dividends, earnings revisions, and market panic. Now guess what? We are selling the same pattern. Unemployment hasn't started to rise yet, it's true, but the subtle signs are there. New vacancies opening, decreasing, companies reducing shifts, reports of isolated layoffs in strategic sectors. It's like a train approaching in the distance. You don't feel the impact yet, but you can already hear the noise on the tracks. And here's what matters most to you who live off income. Companies react to fear even before official data arrives. Even before unemployment explodes, dividends are already being cut. Because CEOs and CFOs don't wait for chaos, they try to anticipate it. Do you want a practical example? Take any crisis from the last 40 years. Whenever the number of unemployment insurance claims starts to rise, it's like the dividends I had evaporated. First they are reduced, then suspended, and if the situation gets worse, they never return to the same level. The only way to protect yourself? Be in position before the last piece falls. It's not about accurately predicting the future, it's about looking at the signs that the market is already screaming, and move before that the crowd notices, because when the cuts start, who acts later? Already lost. Scenario A. The labor market remains strong and the yield curve inverts again. Sounds good? It doesn't. Imagine you are walking on a rope bridge. She starts to sway hard. You think she's going to fall. But then, suddenly, it stabilizes. Relief, right? But here comes the detail. The bridge structure is rotten inside. This is the scenario A. The job market remains strong, unemployment, no rooms, and the interest rate curve returns to the inverter. There are people who celebrate this scenario. Phew, the risk has passed, but those who truly understand the game know this is just the market dropping the bomb further down the line. It postpones the problem. It doesn't solve it. And do you know what the effect of this is on dividend-paying stocks? They enter zombie mode. Earnings are starting to slow, but no one is cutting dividends yet. The market remains stagnant and lukewarm. Investors hold on to stocks that look okay, but will melt down as soon as the next bomb goes off. You get that false sense of security, but inside, companies are consuming cash, accumulating debts, and undermining the sustainability of its dividends. Now, let's be real. Who lives off income can't wait for the curve to invert again to decide to adjust the portfolio, because when it reverses, the market enters a limbo where no one knows what will happen. And in this uncertainty, what do companies do? They save money, hold payments, they cut dividends. That's what happened in 2006. That's what happened in 1999. It seems the worst has been avoided, but all they did was push the crisis further forward, and she came back twice as strong. So think with me, would you rather adjust your route now, or wait, hoping, while your income crumbles without warning? Because the smart investor knows when everything seems too calm, that's when you need to be most alert. Scenario B, when unemployment starts to rise, dividends are the first to feel the hit, and that could be a red flag for your wallet. Imagine a game of dominoes, where each piece represents a part of the economy, and the labor market piece is one of the last to fall. For years, this piece stood firm, holding the entire weight of the economy. People working, salaries coming in, consumption taking place, companies making money. But when that piece starts to wobble, the others quickly fall. And what happens to the dividend piece? She falls soon after. Why? Because dividends, despite being the favorite part of many investors, are an available expense. Companies pay dividends when they make a profit and want to reward their shareholders. But in tough times, with the economy slowing and revenues falling, the first thing leaders do is cut or suspend dividends to save money, avoid debt, and survive the storm. And the hard truth is this: when layoffs start to mount, dividend cuts are not long in coming. Let's look at the history. In the 2008 financial crisis, for example, unemployment began to soar, and a few months later, a huge number of companies cut their dividend payments, including those that seemed insulated. This caused the market to plummet, and investors who depended on these dividends found themselves without a crucial part of their income. Now, think about what this means for you as you are investing to build a steady source of passive income. If you rely on dividends to pay bills, your financial security is at risk. If you don't adjust your portfolio in time, you could end up holding stocks that will decrease or even eliminate your payouts. And the worst part is that these cuts happen quickly, often before most people realize that the economy is going into crisis. Another important point: companies don't cut dividends out of spite or just because of the recession itself. They cut them to protect the business, to ensure they will survive the crisis. This means that dividend cuts are a real warning sign, not a false alarm. And savvy investors know that when dividends start to fall, the best strategy is to reevaluate the companies in the portfolio, looking for those with stronger fundamentals. Look for alternatives that can offer some stability, even in difficult times. And, most importantly, act quickly before the situation gets worse. Therefore, monitoring labor market data, such as weekly unemployment insurance claims, is essential to anticipate this movement. If the numbers start to rise, watch out. Dividend cuts could be coming next. And remember, Whoever realizes what is happening before most has the chance to protect themselves and even profit when others run desperately for the door. Why rising jobless claims are a siren for dividend investors. Let's think of filing for unemployment insurance as a fire. Alarm in a factory. When the alarm goes off, you know you have a serious problem, even if smoke isn't visible yet. In the United States, weekly jobless claims are just that, one of the quickest and most reliable indicators that the labor market is weakening. For decades, that number has been an early warning sign, before official data shows unemployment rising, before companies start cutting wages, freezing hiring, and crucially, cutting dividends. And why is this so important for you who live off dividends? Because when unemployment insurance claims start to rise, it indicates that more people are losing their jobs. Consumption will slow down as fewer people have income to spend. Company revenues begin to decline. Companies will put pressure on cash flow, seeking to cut expenses. And one of the first expenses to be cut is dividends. If you are counting on those payments to maintain your standard of living, you need to be aware of this siren. Ignoring the increase in orders is like staying inside the factory when the alarm is already ringing. You're exposing yourself to enormous risks. History shows that whenever unemployment insurance claims rise consistently, dividends fall shortly thereafter. So, more than ever, monitoring these numbers should be part of your investing routine. You don't need to be an economics expert to understand how this impacts your wallet. Just pay attention to what the data is telling you. And of course, have a plan to act before the storm hits. Your safe harbor. The history and the numbers are clear. When the yield curve shifts, the labor market starts to show signs of weakness, and unemployment insurance claims rise, a recession is looming. And for those who live off dividends, this is a red flag, because dividend cuts usually come before the most visible crisis, directly affecting their source of income. Don't wait for the worst to happen. Pay attention to the signs, monitor the indicators, and adjust your portfolio intelligently and quickly. This way, you protect your financial future and can even find opportunities even in difficult times. Being prepared isn't just about avoiding losses. It's about ensuring peace of mind and security for you and your family.